Hey, David, thanks for being on here with us today. Everyone who's watching this is the long-awaited demo video for HECM HERO, a new sales software. So we're going over that with you today. David Darling is also another CRMP, as am I. There's only about 200 some in the nation. So that's the highest designation for having a reverse mortgage loan officer. David, you can kind of share what it's meant to you a little bit about, achieving the CRMP and what it really means too.
Well, CRMP stands for Certified Reverse Mortgage Professional. And Christina and I are certified by the National Reverse Mortgage Lenders Association. It's an industry association. And that association helps us in our business, and it helps our borrowers and our consumers because they're sort of a liaison between the industry and FHA and HUD. We have direct communications with FHA and HUD, but power is in numbers. And so if one lender talks to HUD versus all of the lenders through the association talk to HUD, that's how we're able to move the ball forward and improve the product over the years. In addition to that, we have sit downs with the legislators from time to time in Washington, D.C. and in some of the state capitals to try and craft legislation that helps boomers and seniors during retirement with a reverse mortgage if it makes sense for them.
Awesome.
We're held to a higher standard than other loan officers. That's sort of a self-absorbed ethics standard. And we adhere to that very, mindfully. So I think working with a certified reverse mortgage professional tells you that you're working with somebody who's taken the extra effort to not only earn that accreditation, but maintain it over the years.
I love every year we have to sign the ethics, and the ethics is so important. But the reason we're on here today also is to go over the HECM HERO. And David is the genius behind the HECM HERO software that personally I think is going to change the way reverse mortgages are done for the better. Borrowers are going to be more educated. They're going to be more in control. They're going to help understand their own loan and structure it through the process in a really simple format. So, David, I'll let you take it from here because I know I'm excited to see what you've got. And there's my face. There's my
there
website.
You are. You're the first HECM HERO. Woo-hoo! So what Christina said is 100% true. I just want to emphasize a couple of little points there. Number one is control. A big part of the philosophy with this application is for the borrowers to be in control of their financial future, to be able to structure a reverse mortgage or to determine if a structure of a reverse mortgage will help them in their retirement. And you'll see a few other ways that the borrower remains in control as we go through this. So this is just sort of a landing page where somebody can, look at the loan officer's beautiful headshot there and learn a little bit about what they do and some of their designations that they got, like the Certified Reverse Mortgage Professional, and contact information. And once they're ready to go, they just get started. And we're going to most of the time be speaking with that loan officer on a Zoom call or at the kitchen table with them, or maybe they're in our office. And we're going to tell them, listen, this is not one of those lead capture engines that you get to on many websites where you put in 3 or 4 pieces of information, 2 of them being your phone number and your email address, and you really don't get much out of it. There's not a lot of quality information you can act on, but you do get emails and text messages and phone calls. This isn't like that at all. We're not asking for any personal information whatsoever until you've gone through this and you decided there's value there. We do ask for a lot of information, however, because we want to give you quality information. So let's just run a hypothetical scenario. We've got a 70-year-old homeowner. They do not have a birthday anytime soon. They're in a $750,000 home, and they're in the beautiful state of Florida. As you can see, not all states are listed here. That's because where this loan officer has the ability to originate loans, those are the states that are listed. So we'll go to Florida, beautiful sunny Florida. You'll self-rate your credit history, excellent, average, or below average. If it's below average, that will trigger the reverse mortgage equivalent of an impound account. We're going to start off with excellent for this demo. It is a mortgage. There are income qualifications, and to make sure you qualify from an income standpoint, we're going to ask about some of your monthly expenses. Like maybe this one has a car loan and they're paying $450 a month on that, and their minimum credit card payments are $150 a month. The type of property could be important, because if you live in a manufactured home, we need to know that it was built in 1977 or year 2000 or 2010. But if it was built in 1975, it's not going to work. How many people live in the home? We'll say we have a married couple here, and they do not pay any HOA dues. And they're in a double wide, so it's 1,440 square feet. And no, they do not own any other properties. It's fine if you do, just sort of good to know during the processing and underwriting of the file. So let's talk about income. All right, we've got income, and they're both retired and they're getting Social Security. So we'll say it's $4,200 combined per month. They've got $15,000 set aside in the bank for a rainy day fund. And they've saved up jointly some IRA and 401k money for those, and they'll be taking out some of the required minimum distributions fairly soon. So we'll say that's $175,000. And that's all of their assets, their liquid assets. For this one, we'll say they're free and clear. They have no mortgage right now. And their annual property taxes in Florida are about $5,600 a year. Insurance is going up everywhere in the country. We'll call it $2,100 a year for that. And no home equity line of credit. Now, when you click on Get Results, you'll begin to see illustrations of how a reverse mortgage could be used and what it could do to benefit a particular borrower. And you'll see different illustrations based on the input, because somebody who's free and clear will look at this a little bit differently than somebody who has a $300,000 mortgage balance that we'd be paying off with a reverse mortgage. So let's click Get Results and see where we go. Any questions so far, Christina?
Nope, I'm loving it. Excuse me, I'm loving it.
Well, most people don't know about this phenomenal line of credit that comes with a reverse mortgage. In this case, we would start off at about $260,000 in the very beginning for this 70-year-old, and it'll grow over time. And it's a pretty phenomenal growth rate. Historically, it's always been higher than inflation over the long term. And this is sort of like a home equity line of credit, except you can't lose it. The banks can't freeze it and pull the rug out from underneath you if there's a bad economy. This is insured by the U.S. government. So as long as you keep your nose clean, in other words, pay your property taxes and insurance on time as a reverse mortgage homeowner and live in the home, this will always be available to you. Now, a lot of people love this growth rate because that would be a lot of money. Look at this, over $1 million if they make it to age 88 or 89 or so, available to them in the line of credit. But a lot of people, they like to have a fixed amount coming in every month. It's easier to budget like that. I mean, let's face it, that's why a lot of people give insurance companies a lot of money and buy an annuity so they can get a fixed amount every month. Well, you get the growth in that instance as well, the monthly payments. For example, if you took the $260 and you split it up and said, give me monthly payments for 10 years, we'd actually would pay you $360,000 over those 10 years, $3,000 a month. And if you wanted our lifetime option and you happen to live for 30 more years to make it to 100, you'd actually get $619,000 during those 30 years. And if you made it past 100, the money would keep coming because it truly is a lifetime option. And that'd be $1,720 per month. So you got this $260,000. There's a few different ways to split it up, not just line of credit or monthly payments. We're going to give you a quick example. You might want to pay off that car loan that you got. You might draw $13,000 up front to do that. You might like the idea of the monthly payments, so you might allocate $130 to that. And whatever's left over, you say, just leave it in the line of credit. Let it grow. If I need it, it'll be there waiting for me. And if we had below average credit, then we would see a property tax and insurance reserve account, our version of an impound account. But we don't see one because we have excellent credit for this example. Now comes the fun stuff. We're going to build our very own reverse mortgage. We start off right here. We see your property value going up at an estimated 3% per year. That's not guaranteed, but it's a pretty safe estimate. This little tiny slice of green down here is your loan balance. That's because there's some upfront fees that are financed like with any mortgage. And if you don't make any payments, it'll go up a little bit over time. And that big blue ocean you see right there, that's equity. So you're free and clear now. And if you get a reverse mortgage, you'll be pretty doggone close to free and clear if you never actually use any of the money, if you're just setting up that line of credit for a reserve account just in case. That's just our opening. We're going to look at some options here now. We're going to be able to change up our interest rate scenarios because this is an adjustable rate mortgage. We're going to monkey around with the property value appreciation rates. Maybe you want some immediate cash to pay off that car loan. You might even want to make some voluntary payments. I mean, if you're getting that money from the RMDs, you don't know what to do with them, this might be a good place to park them. And you might want to receive money from the reverse mortgage on a monthly basis. All of these changes will be reflected in the graph up above and in this table right here. Let's take it step by step, shall we? Okay, so the adjustable rate interest scenario, what you see on the left-hand side of your screen is the history of this reverse mortgage interest rate. And as you can see, it goes up and down and up and down. And that's why we start off with this hypothetical model. It goes up and down and up and down. Nothing scientific about it. If you just look at roughly the average here and compare it to the average over here, this one is a pretty pessimistic outlook. It really expects interest rates to stay high for a long time. And if you think that's a little too pessimistic, you might say, well, what's the historic average over the last 30 plus years? Well, it's roughly about 6% or so. So let's see how that works for us, shall we? We're going to go down. We're going to play with the property value appreciation right now. For somebody that's 70 years old, the average has been about 3.61%. Our default is 3%. And if we stay with our default, when we're 85, our property is going to be worth $1,168,000. If we kick it up to say 4%, because maybe they live in coastal California and that's a little bit more of a higher appreciation area of the country, it'll be a little bit higher, $1,350,000. Now, maybe they do have a car loan. They do want to pull out some cash up front. They could pull out as much as $142,000. Let's just call it $25,000 and that will set them right. Or maybe they want to do a little bit of work on the house. Who knows? You see your graph update right here with that immediate draw. We're going to go down here. You're going to see a cash flow impact, positive $25,000. That's coming straight to you. Would you think about making voluntary payments on your reverse mortgage? Not a lot of people do that. Why don't we come back to that in a minute? Let's think about receiving money. Right now, you see this green. That's the $25,000 you get up front, flat line, because you just got it once. That's cumulative. You're 70 years old now. What about 10 years from now when you're 80 years old, or let's call it 13 years, you're 83 years old, and maybe you're going to need some in-home care. And you don't want it to last for too long because nobody wants to be in that condition forever. Maybe it's going to be 4 years or so. All right, well, you could pull out $12,432 per month for 4 years. That can cover a lot of in-home care. Maybe that's more than what you really want to project at this moment. Maybe you're going to say, I think I can get by. I've got relatives that'll help out a lot, so I'm going to go with $5,000 a month for those 4 years. What's that going to do for me? So as you can see, you're waiting until 13 years from now to start pull out that money. And you'll see the cash flow impact down here. By the time you're 85, you'll have a healthy amount of cash flow impact. If we kick it up a couple more years, that's a few more years of you getting that money. So there you are. You're right now at age 70, you've got a $750,000 home and you're free and clear. At 87, you'll have almost $1.5 million property value. Your mortgage balance will be higher because we're giving you a lot of money and you're not making any payments. And your equity will increase from $750,000 to over $1 million. That's right, over $1 million of equity with a reverse mortgage where we're paying you $265,000 and you're not making any payments. I think your heirs would be very happy with $1 million of equity. I know I would if I was an heir. So if you add the two together, you've got a net positive impact with this thing of $536,000 at age 87, and you still have access to $667,000 in your line of credit. Can you think of any other product that will do that for you? An annuity won't do it. A cash out refi won't do it. A home equity line of credit won't do it. And it's real simple to kind of play with this a little bit to find your comfort zone. Now, if you said, okay, I am getting those RMDs, I don't need all of that money. Maybe I should put it into this line of credit because it's growing so well. I'm 70 now. I'm going to start getting them at age 73. I'm just going to test the waters a little. I only want to do it for 2 years. And then I'll decide if I really like how it's working out. And I'll put $1,500 a month into it for those 2 years. Relatively minor, but it's going to change things a little bit. Now you see some red down here because that's money coming out of your pocketbook for 2 years. So that's negative cash flow. And that'll be down here. It'll impact your cash flow down here. As you can see, not a whole lot of change to these numbers. Your mortgage balance is still reasonable. You got 1.1 million of equity now, a little bit more than before. And it all went into that line of credit. Now you're over 740 in that line of credit for just making those small payments for 2 years. And you were probably wondering, what am I going to do with that money anyways? Put it in the bank? That's not doing any good. So if you like what you've done here, you click on, I like it. Let's go. And earlier, Christina said the borrower is in control. And here's another example of how the borrower is in control. If they're ready to take the next step, they'll give us their information so we can help them and take that next step together with them. If they still aren't sure and they want to think about it a little bit more, they'll click right here and they can download the scenario they just created. Maybe they want to share that with some of their kids, or maybe their financial planner or their CPA or whatever. So there it is down there. They can open it up, attach it to an email, and send it to whomever they want to send it to. Otherwise, they'll put this information in here. We'll call this one Francine. I'm good at doing software, but I'm crappy at typing. Francine Jones, here we go. She said she was 70 years old. So we're going to know that's a 1953 birth year. And we'll set it up for, how about Flag Day, June the 14th? That's a good day to have a birthday. Her email is fj@jones.abc. I'm not going to give a real email address because I don't want this going to somebody out there. And they'll say, what am I getting this for? Address, 726 3rd Street. In beautiful Encinitas, right around the corner from the American Legion, where we like to go to hear live music. In California, 92024. So if they click here, continue, they'll get an email. And that email will basically say, hey, thanks for visiting our website. Before we send out any personal information, we want you to confirm that you got this email. They'll click on confirm, and then you know they're interested. They'd like to take that next step forward, and you'll reach out to them, and you'll have their information. Well, hold on. How am I going to get their information, you might ask? Well, do you think I ought to show them that, Christina?
Oh, please do. I love this for company owners and or loan officers who are leading loan officers who don't fully know all the ins and outs of reverse. This next section, pay attention.
So now you're in your loan officer dashboard, and you're going down here and you're looking at Francine Jones. It's red right here because she did not open up that email and click on it yet. This one down here did, so that's green. So we're going to just kind of take a look and see what we've got here. And here's the data entered by Francine, 70 years old, $750,000 home. So you can do a little bit of research. Okay, she's in a manufactured home, and oh, she's in Florida, and I wrote down Encinitas. I wasn't paying attention. Oops, sorry, my bad. Then you got a little calculation summary over here. The margin is 2.75 on this one. We've got an expected rate index. So if you're new to reverse, these numbers might look a little funky to you. You'll get used to them pretty quick. But the beauty of this is you don't have to do the monkeying around with the interest rates. It's all done for you. You don't have to look at a rate sheet and spend 15 minutes scratching your head. That's why I don't have any hair left, because of all the rate sheets I had to look at scratching my hair. It'll price it out for you to a compensation level that you're comfortable with. So think about that, if you will, for a moment. Think about the financial planners you have relationships with, the CPAs, the enrolled agents. They're financial professionals. They'll be able to navigate this just like that. So they just, boom, go to your website when they're sitting with somebody that they think might benefit from this. They build the reverse mortgage on their own. You don't even know about it until it pops into your dashboard. Well, by the way, you will get an email as a loan officer saying, dude, check your dashboard. You got a live one. So here's how it calculates it out. It basically comes down and says, all right, you got a utilization of 20.7%. You got a loan balance of almost $60,000, gross revenue close to $14,000. If you're a regular loan officer and you got a $60,000 loan balance, have you ever seen gross revenue of 14 grand? Yeah, I know the answer to that question. Got to pay for processing. You might have a referral that you're paying to one of your branches for sending that lead into you, perhaps. That gets you your net revenue. Brokers got to get their slice of the pie. So you're walking away with $6,000. You will define as your own loan officer whether you pay a referral fee to a branch. You'll define if you're in a broker shop and the broker gets 30% or 5% or a flat fee or something like that. You'll define it one time when you sign up. And if it changes, you'll refine it again. But otherwise, just sit back and let this happen. Now, I talked about this sort of passive income by just letting somebody use your website. And all of a sudden, you're walking in here and say, hey, that wasn't bad. Got a $6,000 file here. It could also be that you might want to run this scenario that we just did before you actually meet with the client. Maybe it's referred to you by a real estate agent or a former client or something like that. So you run the numbers first. And then you decide how you want to structure this going forward. And we'll get into that in just a moment. But here we're still with Francine Jones. Here's the pre-qual. She's got yeses everywhere, so she qualifies. Here's her residual income calculation. That's right. You don't have to do that either. She qualifies from that. And here's her contact information that she shared with you. So we're going to go back over here to the dashboard. Go to Christina's. And here's where you set your compensation for your reverse mortgages. This is your passive income chart, if you will. If you'll remember, that last one was just a hair above 20% utilization. That's why it landed right here with the $6,000 compensation. The computer just figured it out to make it work. And here's the processing. Here's the broker override. There's the referral fee. Here's your loan officer information yourself, what shop you're working for. You upload your logos in here. Here are the states where you're licensed. When you're a new loan officer, you'll be entering all this information. If you need our help, we'll be able to help you. And then if you have to change things down the road, you get licensed in a new state, just edit it and come in with a new state. And this down at the bottom is where you find your leads, your Francine Jones and the others, and you just kind of keep clicking through like that. So Christina, that's pretty much what we have to show for them right now. I mentioned there's other scenarios that'll look a little bit different if somebody's short to close. We got a couple of fixed rates in there, but they're all relatively similar and very easy to navigate.
Yeah. So a couple of things I want to just mention here. This is just for HECM, right? It's called HECM HERO. We are not including proprietaries at the moment because proprietaries change weekly right now. So in the future, it may include proprietaries. So I want to get that question out of the way. The reason this software I think is so impactful in so many different ways is because, you know, if you're a forward loan officer and you've never done a reverse, you may be looking at this stuff going, well, that's pretty similar to what my forward lenders offer. I just go into their portal, type in some stuff and send the borrower a link, and then the borrower completes it. Well, that's new to reverse. And so this HECM HERO is the only software that actually does that in this way, that actually qualifies the person. So if we run through another scenario, you can see some different, if they don't quite qualify, they don't have enough equity, their RI doesn't work, it spits out different answers. Then the other part is this lowers the need for loan officers to need to know how to do so much, right? How to price when, when I talk to a loan officer from the forward side and the coming to the reverse side, unless they've been in the mortgage industry for 20 plus years where they used to use rate sheets, a lot of the time it's pretty foreign. They're like, I have to use a rate sheet. How do I even do this? Where do I get the numbers? And you have to refer to this loan software and you have to refer to the rate sheet and you got to do some math. And then you also have to do that again at closing, which you will have to do at some point. But this takes the onus off of the original labor, to even structure a reverse mortgage. It takes a while. It takes way longer, in my opinion, than structuring a proposal for a forward mortgage. This offloads some of the work in that. And then David has created bumper rails so that we're not accidentally pricing loans that, we're going to have to pay to close, or pricing loans where it's just astronomically not in the benefit of the borrower. A lot of the reason I started the coaching company was because I saw loan officers not knowing how to do this stuff. And this software is going to make it so much simpler. I just don't want to have to use my time in that way. Even though I do know how to do this, why would I when this exists? And so for newer loan officers or loan officers trying to build their teams, just bringing more loan officers into the fold, helping you guys get an order from your client, pretty much that's what this is, right? If you have this link on your website or in the bottom of your email and they click and they go play with it for themselves, they're pretty much giving you an order. And from there, you take this order of, okay, here's all the info. Here's how they actually want this, right? They modeled some monthly payments. They modeled a line of credit. Now you go and actually put that into Reverse Vision, Quantum, maybe a lender's proprietary software you're using, and you create a proposal like that. It is just cost saving, time saving in every which way. So yeah, David, I'm blabbing because I just love it so much. But it looks like you're ready to show us another scenario. Let's keep going.
This is one that's not going to qualify, so I thought it'd be interesting to see what happens there. We've got an 80-year-old homeowner in a $560,000 home in Idaho with below average credit, and that means whatever reverse mortgage money is available, we're going to withhold a healthy amount of that to be able to pay property taxes and insurance out of that withhold amount in the future for this homeowner. And the future is expected to last what the actuarial tables say an 80-year-old is going to live for. We've got some installment payments, credit card payments, single-family home and an HOA with $300 a month, a few thousand square feet. They got good income, $12,500. They've only got $5,000 in the bank. Pretty tight there. And they're sitting on a big mortgage, $475,000. Now, Christina and I know right now she's not going to get $500,000 in a reverse mortgage out of a $560,000 home. That's not going to happen. So this is going to be a does not qualify. And it's pretty extreme. You'll have some other ones that are really close to qualifying. But let's see what happens. Okay, so here we've got a little message for the borrower to say, the amount from the reverse mortgage is not enough to cover your liens or your tax and insurance reserve. Maybe you overlooked over other assets. Give us a call. Let's get together. Maybe we can figure this out. So they can just click on this and say, yeah, let's figure it out. Pop in their name, pop in their email, and boom. That email will go to them. They will click on it. It'll be verified. It'll be in your dashboard. You'll be able to see what they entered in here. And maybe it was a simple typo. Oh, I didn't put in the $1 million that I've got in the bank. Sorry about that. My bad. So even if it's a DNQ, doesn't mean it's a goodbye forever. If it was an income shortfall, you'd have an income shortfall message. If it was one that was much more vague, it doesn't really meet our scenario analysis, policies, and procedures, or something like that, that tells you that maybe you wanted to make $6,000 on the file and the most you can make is $5,000. Things like that might happen from time to time. So as long as they click here and say, yeah, let's talk about it, you can save that one. Doesn't happen too often, but that will happen once in a while.
I would say for those of you using this as a training video, go and review. When you get somebody that doesn't qualify, go ahead and look at the file, because if they don't qualify based off of your income parameters, maybe you'd be willing to do a lower amount, or maybe you just need to lower your income parameters so that you can lower the margin some. And that will make them qualify, because as we know, interest rates go up, loan amounts come down. Interest rates go down, loan amounts go up. And so within a little bit of wiggle room, you have control. Market dictates most of that, but 2.75 down to 2.5, that will make a difference for the borrower's loan amount. And you may be able to figure out, oh, I can't help this person, but you've got to be reviewing these, because the borrower may not request a loan review. They may just go, oh, okay, I don't qualify.
Yeah, especially when you're new to reverse. You should basically run this as much as you can before you actually meet with that prospect. You might not have all of the information. You might make some guesses on some of this, but you click on Get Results. And if you're getting good results, meaning you see the graph with the big blue ocean of equity, then you're good to go. If you get the do not qualify, then before you're even in the room with that borrower, you're going to look back and say, okay, so let me see here. What can I do to fix this? And you put in your own email address. And that way it shows up in your dashboard. And you can kind of look through that and save it that way. And as Christina said, maybe it's just a simple adjustment that you have to make here or there. And then all of a sudden you've got a file that will work to both of your satisfaction.
Couple questions I can hear the audience asking. Why does it matter if their birthday's within the next 7 months, David?
You always have voices in your head there, Christina?
Always.
Really? Okay. So within a reverse mortgage, it's all age-based. The older you are, the more you get. I like that, by the way. And if you're within 6 months of your next birthday, when you're signing the final loan documents, we get to count that next birthday. So here, if we're asking you that if you're within 7 months, then we'll go ahead and use that in our calculations, because the time between when you're on our software and signing the final loan documents, it's probably going to take a month or maybe a little bit longer. And if we need to stretch it out for a week or two to get that extra $3,000 or $4,000 for you, that's what we're going to do.
Awesome. All right, next question. Now, if the file is tight on residual income and they have a lot of equity, one of the compensating factors you and I know how to use is to appropriate some of that equity into the income calculations. Does the software automatically do that?
Bada bing, bada boom. Let's have a look-see, shall we?
Okay.
Let's pull up Francine Jones on her residual income calculation. Here we go. So she reported $4,200 of income. Can you see that okay? Let me make it a little bit bigger. There we go. She reported $4,200 of income. This is it. It's called dissipation income. That means she has certain assets and possibly money coming out of the reverse mortgage. We're going to take that total, just call it $40,000 for this conversation. Then we're going to divide it by the number of months she has left to live according to the actuarial tables. And that in this case would be $2,354 per month. You don't have to ask for any documentation on that. No tax returns are going to show that. All you need is really her bank statements, or if it's in the IRA statements. And if it's in the reverse mortgage proceeds, you don't need anything. So it's a real easy income boost to qualify those tight files. And yes, HECM HERO has already thought of that. That gives you your total income of $6,500, property taxes, insurance, HOA dues, installment debt, credit card debt. This is our VA calculation. We use it in reverse mortgages too. 14 cents per square foot for maintaining the property. That gives you your total expenses. So you got residual income, which is the $6,500 minus the $1,400 is $5,000 of income. They needed $961 because there was 2 people living in that Florida house. And I just got a little pad in here for $75 a month, just because these numbers are never 100% accurate. But anyways, this one's in excess by over $4,000. So that's a slam dunk. But if we have one that's pretty close, we got it padded, because I don't want to DNQ somebody for over $75 a month, because we'll be able to make that work.
From the getting the loan through, you can actually tell right off the bat, you may not need to request all of the financial documentation, right? If we're 4,000 above where we need to be, then maybe you don't need to ask for all of those accounts. Maybe you can just say, okay, as long as we get, a little pad, 500 above where we need to be. And that might ease the documentation burden too. And you can see that right away. Like this stuff to me is just absolutely amazing, because so many of these things I would have to reference like 3 different documents on my screen, right? I have a PDF up, I have the guidelines, I have the actual loan software where we're creating things, and I'd have to reference it all. And now it's just right here. I love it. Okay, another question. If we could do a scenario of somebody who needs a Lisa, if they had chosen poor credit, how does that actually affect their file?
Okay. 78 years old. Yes, they've got a birthday coming up pretty soon, so we got to order a cake for them. $650,000 is the property value. Let's see where Christina's licensed. We'll pick one we haven't been to yet. Minnesota. Oh, we're going to go to Minnesota. Okay. Yeah, you betcha. Below average credit. That's what we're doing there. Monthly installment payments. Let's see. She's 78 years old. She's paid off that car loan by now, by God. $125 a month of credit card payments. She's living in a single family residence, all by her lonesome, and no HOA dues, 1,850 square feet, no other properties. And Christina, how fast can you do this in the other software?
Oh,
$4,200 a month of income. She's got $25,000 sitting in the bank for a rainy day fund. And still $75,000 in her IRA. And that's it. No other assets. All right. We'll do this one without any loan, just so it really sort of illustrates that one. We'll put a little one on there. What? $75,000. And her monthly payment on that is $750. She's got 12 years left on it. And yes, there are impounds accounts on that, because that affects the cash flow. Annual property taxes in Minnesota, I don't know exactly. I'm going to call it $4,500, and $2,000 for homeowners insurance, and no home equity line of credit. Bada bing, bada boom. So this one's a little different. You're not going to see that same chart that you saw with the line of credit growing, because this one, they've got a decent sized mortgage that will be paying off. You can see that same 3% property value going up. They've got a little bit of a mortgage balance, and we're going to be paying their property taxes and insurance. And they're not making payments on the mortgage. So here you have a little bit more of an aggressive growth factor on the green loan balance. Your line of credit's also growing. And here's your big blue ocean of the home equity.
Now, before we leave that screen, I actually want to just say some pieces. I know why this is so important. So the mind works in pictures. And so a lot of the time in the past, we've talked about going over the amortization schedule. And it's a lot of numbers. People's eyes kind of cross. One thing about this software that immediately I got so excited about was this particular graph, because we have other softwares, or we had other softwares that show the loan balance, the line of credit, the property value, and nothing actually gave a good representation visually for how much equity there actually was. And this particular chart does, and it actually shows the proportion, right? You have way more equity. So the idea of, yes, the loan balance is increasing, but also your property value is increasing. And so what is that relationship over time? This shows it, because you hear people say all the time, oh, well, it's going to eat up all my equity. Really? And when you verbally question it, it doesn't make sense in people's heads. When you have a visual representation, the mind can actually wrap around that and start to make some decisions. And so this, to me, David, was just absolutely genius. My favorite piece of this whole puzzle.
I like that you like it. I've got to tell you that using that old software that you're describing, I would sort of joke about it sometimes when I would have to use that with a borrower. I'd say, this is one of two things. It's either a street map of London or your reverse mortgage. Which one do you think it is? And you couldn't really tell a difference. All right, so just like that last one, we got a few things we can do to kind of play with and build our new reverse mortgage. We got our summary table down here, and we can change the years if we want to. Say, okay, what happens if I make it to 83 years old? How do things look like then? And a condensed chart down here, all kind of nice and tight. And down here is our cash flow chart. So let's start with that one, shall we? We're going to be making those property tax and insurance payments on their behalf out of money we're holding back in that reverse mortgage. So you can see how it flatlines right up here at age 90. That's when we stop paying. We've used up the account. It's done. And they'll get notices beforehand saying, hey, it's on you now. We've used up all of our money. You can make those payments on your own. And here's an inside pro tip. If they still have a bunch of money left in their line of credit, like this one does, they can just say, you know what? Take $50,000 out of my line of credit and just park it in a brand new tax and insurance set-aside account because I don't want to write those checks. Boom, $20 fee for making that happen. Pretty flexible, right? Okay, so we can play with this a little bit if you want, but honestly, for the tax insurance set-aside, that's your main illustration, if you will, to kind of show people that's where the money's going. And even if it goes, you're fine. You're going to have a big blue ocean of equity here, and you got plenty of loan balance going higher, but you're comfortable with that. And you got a lot of money left in the line of credit when you're 83. And if you have good genes and good health and you're a vegan and you don't drink, maybe you'll make it to 87. And you see how things change for that. You benefit $81,000 cash flow benefit. Your equity's gone up. They have a net positive impact of 120 grand without making any payments at all, and $270,000 almost in the line of credit waiting for you.
All right, question on this graph. What are legacy mortgage payments? I see the pink on top of the yellow there.
Right. Those are the mortgage that we are paying off. I believe she had 12 years left on that mortgage. So that's 12 years worth of mortgage payments that she doesn't have to make anymore. That's a cash flow benefit for her. And then they go flat right here at the 12th year because we're not going to keep paying them because she wouldn't have kept paying them.
Awesome, awesome. And then no voluntary payments, but I can see if we wanted to include those would show up too.
Absolutely. So you want to make a few voluntary payments. This is a pretty cool hack. I hope you're probably paying attention. All right, let's say you want to start immediately. You've got that mortgage. You're making payments. It's a little bit tight, but you could do $500 a month. You say, all right, I'm going to do $500 a month for 10 years. Well, ooh, looky here. If you wanted to make an interest-only payment for those 10 years, your payment would be $979 a month. Interest only is a very common term in the regular mortgage world, but you don't hear it in the reverse world. And this is based on an interest rate assumption. So if you choose a different interest rate assumption, it's going to change a little bit. Do you remember what that number was, Christina? The interest only?
No. Oh, 979.
All right, here we go. That was the historic rate. Let's say we use the rate that the government borrows money at for 10 years, the 10-year reference rate plus a regular margin. That's a little bit higher, so it adjusts. It'd be a little bit higher. So we don't know exactly what the rates are going to be like in the future. You could, if you're a CPA and you want to build your own custom scenario, you can do that if you want to. And that would adjust up above as well. Let's kind of leave it back at the historic one. And we'll leave it at that $500 a month for 10 years. And we'll come down, we'll take a look. And now we'll see the red. Those are the voluntary payments. That's negative cash flow. So now you have a much lower negative cash flow. You're still ahead of the game, $27,000 ahead. It's not negative, but all that money went into your line of credit. You can pull it right back out again if you want. I mean, if you give it to Bank of America, you're never getting it back unless you sell or refi. If you put it into your reverse mortgage, you can have it back anytime you want and benefit from the growth, insured by the U.S. government.
If you look at the graph now, you can see the green
Whoa!
doesn't meet the yellow. There's so
Whoa!
much room there.
Whoa!
Yeah, this stuff is awesome.
This will be the scenario you're in most often, just so you know. I think it's nice and tight, it's compact. Yes, there's quite a bit of information. You can always collapse it, and just kind of refocus. How does this look? I don't think I'm going to make it to 87. It's not going to happen. All right, let's bring it down to 82. What's it look like then? Are you comfortable there or not? You know?
Yeah, this is beautiful. One other thing I hear from borrowers all the time is the appreciation rate. So in our other softwares, 4% is a mandatory number. And I get a lot of pushback on that from, I had a guy who his house was worth like 7 million. And he was mad that 4% was not realistic for his property value that was way high. So we'll see like the lower values and the super high values. 4%, the national average, is appropriate for a lot of markets. It may or may not be appropriate for their market, and or that homeowner just may not want to see 4%. They may think that it's worth 6% appreciation or 2%. So knowing those appreciation rates and perfect example, I can see you doing it right now. Appreciation isn't always the exact same every single year. And you have the ability to actually manage that.
You can make your own custom one. It can go up and then hold steady and then go up again, whatever you're comfortable with, and it'll reflect itself down here. Now you see a little bit more of a pronounced curve in the property appreciation because of what you've done up here.
Which, as we're talking about this, we should also mention it did not impact the line of credit. That line of credit is not impacted by the appreciation rate, which is a common misconception. The interest rates impact the line of credit. So when you mess with the interest rates, that's where you'll see that line of credit change, not the appreciation. And that's a cool HECM thing.
So, Christina, you talked about the amortization schedule a little bit earlier. There's really two sort of static pieces of paper that we usually show borrowers in the old days. That's one of them. The other one we call the comparison page. There's way too many words that might as well be in Greek because they don't make sense, and way too many numbers. But what we do see on those pages are fees and interest rates. Do you see any fees or interest rates here? Mm-mm. We're only talking about what it can do for you. We're not saying you need this. We're just saying let you decide whether this will benefit you or not. Because if it's not going to benefit you, whether the rate is 1% or 15%, doesn't matter. Whether the fees are $5 or $50,000, doesn't matter. If it does look like they make sense, then you click and you say, I like it, let's go, and you give us your information, and then you get a full-on disclosure, and we talk it through. So we're not hiding anything from anybody. We're just focusing on what is important to make that principal decision. And if they decide they want to go for it and they like it, and then they see, well, gosh, that interest rate's higher than I thought it was going to be. I don't want to do this. All right, you're a grown-up. Make your own decisions. If you're new to reverse and I'm asked about reverse mortgage interest rates, I typically say we're lower than HELOCs and higher than regular mortgages. We're right in between the two. Okay, we're in the market.
Great answer. Everybody use that one. There was one more piece of this that I wanted to talk about. Oh, okay. Purchase. Purchase is not currently an opportunity in the software, but it will be. So anybody trying to run purchase numbers, you can kind of run them based on some scenarios, but it's not going to give you data that is easily interpreted. You're going to have to do a little legwork to figure it out.
How about a smartphone app? What do you think about that, Christina?
Let's talk about it. You mean I could be at a party talking about reverse mortgages and I could just pull out my phone and go, toot, 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 toot. Yeah, you could probably do a reverse mortgage, or your parents probably could.
Well, I just hope you'll be talking to a real person and there won't be voices in your head. That's my only concern, okay?
The voices in my head help. They tell me about the person I'm talking to.
Okay. So this is a mock-up of what you have on your smartphone. It's real simple. What's the age? Okay, 55. What's your property value? Okay, $650,000. How much do you owe right now? 150. And what state do you live in? Oops, better add one more zero there. What state do you live in? Once again, it's got to be one where that loan officer is licensed. Let's get some results. Whoa, you can actually get some money on this. Did that surprise you, Christina?
It did. I said 55. Well, that's not for a HECM.
That's the young spouse. That's the young spouse. We're assuming that you're married to somebody who's over 62. We don't want to say no. We'd rather say maybe.
Interesting. Maybe. Well, and that brings a 55-year-old in the door, and we might have some products. If there really isn't an older spouse, we might have some products that could work for them.
Plus, if you're at a party, that's one of the first questions you ask. So, are you married or what? Right?
Yeah.
Okay, so what happens if they're 75 years old? It was a little typo or something like that. And we say get results, the numbers will change. So now you know after paying off the liens, there's $117,000 available. There's more to it than this. This is just sort of the super high 30,000 foot level. But you got your comp baked into this. So it's a deal you can do and make money at it. And there's probably going to be about 117 because most people income qualify for a reverse mortgage. And most people don't have that tax and insurance reserve account. So this is pretty doggone close.
I was on a coaching call.
Bam, go ahead.
I was on a coaching call today, and one of my pieces of advice was, if they have enough equity, if the equity makes sense, you can pretty much figure out how to qualify them with a lot of my coaching courses. How you have experience over the years, you just gather these know-hows and figure out. It kills me when I hear somebody call and said, I have enough equity, but so-and-so said I didn't qualify. I always dive into that file and sure enough, make it work. There's ways to make it work in reverse. Whereas on the forward side, they're in the habit of turning a lot of people down, and on the reverse side, we don't really have that as much.
So here's a quick little hack since you mentioned this. Somebody who's 75, we expect people to die in their mid to late 80s. So that's a little over 10 years. Let's just round it to 10 right now. 117, that's pretty close to 120. 120 divided by 10 years is $10,000 a year of income that we can use to qualify them without any documents other than their bank statement, the reverse mortgage information.
So that's a great thing to go over. That's news to a lot of loan officers. Wait, you mean I can use, well, first off, just that we can dissipate assets without actually having to have a letter saying they're going to start receiving funds within 60 days, like the Fannie Mae, the typical mortgage guidelines to be able to use that kind of income. That's the first shocker. Second shocker is, wait, what? I can use the proceeds from the reverse mortgage to help them qualify? Well, yeah, because it's income. They're going to be having access to the line of credit or actually receiving monthly payments. And when I say income, not income for tax and insurance purposes. I am not CPA. This is not financial advice or tax advice. Got to sneak that in.
That's right.
Now, David, quick question. Let's say, as we commonly hear, the mortgage balance was, let's go 350. And that's a lot of the time we'll hear numbers that we're like, oh, I can't quite qualify that quickly in my head. This is right on the cusp.
You're short by 82 grand. So this one you might hold close to your vest and not really show them you're $82,000 short. You might say, not quite enough to pay off your current mortgage, but we ought to sit down and look at your overall portfolio of different assets you've got. Maybe you have some that are in a super risky environment, and maybe you want to put them into a safer environment like real estate. Because if this person has $400,000 of retirement accounts and $375,000 of it is in stock market, it's a pretty simple suggestion to say, why don't you kind of take $82,000 out of that risky stock market and put it into real estate in Virginia? Because that's what you're doing. You're putting it into your house.
I love this. You could even say I coach a lot of loan officers like this. That's why I'm mentioning it. Say that you are the one reverse loan officer in a mortgage company where there's many forward loan officers. you can have them access this and quickly figure out if it's qualified. That's one of the biggest pieces of headaches I had as the few loan officers that did reverse within a larger company, where they're asking for help. Hey, you're the reverse person. Does this actually work? This is so much simpler, right? You don't have to say,
So,
hold on till tomorrow till I can be at my desk doing it.
so if you've got 40 colleagues and all 40 of them have your app on their smartphones, and they're out there in the marketplace and they see click results and they share it, and they share it with Betty Johnson, and Betty Johnson gets that email and she clicks on it, confirming that she got that email. Then it's showing up in Christina's, well, it's showing up in Christina's dashboard anyway, even before the click. But once it's been verified, then she knows she's got somebody who took the effort to verify, and that's somebody who wants to have a conversation. And what did Christina do for it? She just charged each one of them, what, $10,000 for the app?
I mean, that's not a bad idea, right? They could use some of those forward loan officers to offset the cost of their subscription. And I want to be really clear too. This is just a sales software to help streamline the possibilities and the sales cycle. This is not an originating system. It's not an LOS. So you would take this information and then you would enter it into your LOS. Common ones we hear used are Quantum, Reverse Vision, and then some of the lenders have proprietary platforms. So you would take this info and put it in there. This is not going to flow all the way through, at least at the current moment. We're not an LOS. I don't think we have ambitions to be. We want to really make it the sales simple, show all the things to put the borrower in control, and then you as the loan officer take it to the LOS.
Right. And we're on the page here where you can enter your information if you want to, and down below we got some disclosures and disclaimers. And you need to kind of prep the borrowers that say, listen, this is a great tool for helping you make a decision. HUD did not create this. So you're not going to see HUD's loan or reverse mortgage application or their final closing documents with all these graphs and charts and things like that. You're going to see what we're currently using, which is the static information. So it's going to look different. That doesn't mean you're not getting what you want to get. You're just, going to have to look back in time about 10 years or so. That's kind of your mindset when you're looking at these HUD-approved application and final closing documents. So it's a different look, but you're still getting the same reverse mortgage with all the flexibility and all the opportunity to make payments, receive payments, grow the line of credit, and so on.
Perfect. All right, that was our CYA language. I think we're about through the demo.
I think we are.
So wherever you're watching this video, if you want access to HECM HERO as a loan officer, you must be a licensed loan officer. Reach out to us. This is an amazing new software going to change the entire industry. We've got different ways to access it. All right. Thank you so much for being on with us today, David.
Thank you for having me. It was so much fun.
Yeah. And thank you all for sticking to the end and really seeing the software for what it is. All right.